and thank you for joining us at FutureMoneyTrends.com. I'm here with John Rubino. He's the author or co-author with James Turk of The Money Bubble, What to Do Before It Pops. John, thank you so much for joining us today.
Thanks for having me on, Dan.
John, your book was a great history lesson. It also goes over where we are today for people, things they need to understand, and of course, how to prepare for the crisis. It even covered the digital currencies, which has been really popular last year. John, in the second book that you've written with James Turk, The Money Bubble, I want to ask you, what was the difference as far as the environment and your overall thoughts of what's going on right now with central banks and government, as opposed to when you wrote a book pre-2008? I mean, how was it different when you wrote this versus, I believe the previous one was Dollar Collapse, right?
Yeah, the 2004 book was The Coming Collapse of the Dollar. And the difference between now and then is that everything's bigger now. We've made even bigger mistakes in an attempt to fix the mistakes that we made in the past. So this is a lot more extreme environment, even though to most people it probably doesn't seem like that, but it really is, because all the numbers have doubled. You know, back in 2004, 2005, 2006, we were racking up debt levels in the U.S. and most of the rest of the developed world that looked to James Turk and I like it was the end of the road. When that bubble burst, it was over for fiat currency and for big government and for global military empire. All of the manifestations of fiat currency, of easy money, looked like they had reached the end of the road. We were wrong, that it had one more big iteration left. And basically, after the 2008 crash, the world's central banks dusted off some theoretical ideas, some extreme theoretical ideas like quantitative easing, and basically just monetized tens of $1 trillion of debt out there. And that was something that I would have thought would have been impossible, because it seemed like with say the U.S. government running a deficit of $1.5 trillion per year, and buying up 70 or 80 or 90 billion dollars of debt per month, that people would figure out that that's a prelude to Weimar Germany style hyperinflation, and then just dump the currency. But it didn't happen. So instead of fixing things, what this has done is allowed us 10 years of breathing room in which to pile up even more debt and make the system even more fragile and bring about an even bigger crash. So this one is really the fiat currency bubble.
While doing the research for this book, where there's this 9-year gap between your last book, is there anything that you and James came up with that kind of either surprised you, caused you to pick up the phone and call him, or just kind of said, wow, we have to put this in the book?
Oh yeah, so many things have happened in the last 9 years that are just extraordinary, and one of the really interesting things is that a lot of theoretical frameworks have emerged or been dusted off to explain what's coming. Because we've built up so much debt, we've created the potential for some form of chaos to come about, but it's not clear how we get from here to there. So we included a section in the book that details some of the different scenarios that would lead us from where we are today to the chaos and the resolution of the chaos that's coming. And there's the Austrian economics crack-up boom, in which everybody figures out at long last that inflation is an explicit government policy, and that the currency is going to get less and less valuable year after year, so they just dump the currency. And so you have a hyperinflation that is really a loss of confidence in the currency rather than an oversupply. And there's the currency war, Jim Rickards' idea that we're in a period when over-indebted governments have no choice but to depreciate the currency. But that only works for one government because it disadvantages their trading partners, who then have to respond in kind. And so we get a race to the bottom until they've destroyed the major fiat currencies of the world. And then there's one that I thought of called the variable rate world death spiral, in which low interest rates for a long period of time have convinced basically everybody in the world to either borrow very short and roll over their debt continuously, or to adopt variable rate debt structures, which means if interest rates go back up, everybody's interest cost explodes. You know, the Japanese government, the US government, most of Europe, most of the leveraged speculating community in the US and around the world, they all depend on low interest rates. So if interest rates even go back up to normal levels, say 6% on a 10-year treasury, the world blows up. And that's a very, very easy to envision scenario. And there are others in that section, but basically they should serve as lenses through which you can view the world. None of them are guaranteed to be 100% accurate, but they all give you some insight into what's going on and what might be coming.
Well, what's scary about the scenarios that you guys bring up is that you see just how close we are to any one of them happening, or a mix of them happening. On the interest rates, though, you do bring up something that it's like kind of like a no-brainer. Like, well, look, if interest rates go up, I mean, it blows everything up, from governments to just the individual debt obligations that we've committed ourselves to. So knowing that, won't the Federal Reserve and governments worldwide won't they just flood the world with currency before they allowed interest rates to go up?
Yes, that's the box they're in. If they let interest rates go up, their world ends. But in order to keep interest rates down, they have to continuously pump new currency into the system, and that feeds asset bubbles. Because already we've got equity prices at record levels. We've got high-end real estate in most of the attractive markets around the world just blowing through old records. We've got art prices setting records, jewelry prices setting records. The super rich are building storage facilities in Asian airports that are beyond the reach of any given government in order to store all the art and other hard assets that they're buying with their fiat currencies, because so much new money is being pumped into the banking system and then handed to the rich clients of the banks. So we're there now, and let this go on for another few years in order to keep interest rates down, and you'll get even more extreme asset bubbles, which they themselves are destabilizing. They'll blow up, and then the system will flake out. And so the world's central banks are really in this box where it's only one or the other. That's the only choice that they have if they don't want to just collapse into a deflationary depression, which is what would happen if they just stopped monetizing the debt.
One of your chapters did cover digital currencies. This is still early and speculative by definition, but you guys do put it in your book. You kind of leave it up to the person to make their own decision. So I just want to ask you, between you and James, who owns Bitcoin? Is that something you guys are using for a wealth diversification plan?
James is very interested in Bitcoin as a business line. His company Gold Money is looking at setting up a payment system that is, and I don't want to venture too far into the details because I don't know them, but it's going to use Bitcoins for some kind of a payment system. And my take on Bitcoin is that it's one of the big stories of 2013, the emergence of a fully functioning cyber currency. But I think we have to differentiate between money, which is a real asset like gold and silver, something you can hold in your hand, and Bitcoin, which is, generally speaking, bits in a database. And so it doesn't have physical reality. And so it sounds like it's very, very functional as a payment mechanism. But it's dangerous as a savings vehicle. If you put your life savings on a hard drive in Bitcoins, and then the hard drive crashes, you can lose that. But you can print out the data for your Bitcoins, and that piece of paper serves as money. So you can convert Bitcoins into a physical form, but that's not how most people do it. Yeah. And so I think people who are enthusiastic about Bitcoins should recognize that that if it's not in your hand, then it's inherently risky in a way that physical gold and silver aren't. So I think it's very possible, and we have to see how these things work. If Bitcoin is the final form of cryptocurrency, or if some successor technology comes along that's even better, I don't know. But it's easy to envision a world in which some form of cyber currency is our medium of exchange. That's what we spend, and physical gold and silver are our savings vehicle. That's where we hold our risk-free assets, the stuff that we can't afford to lose, and the stuff that's the basis of our financial stability. And those two things completely bypass the world's fiat currencies. So you would, in doing something like that, become completely internationalized. You wouldn't have to worry about any one national currency being mismanaged and destroyed. And I like the idea of that world. I think that's a much better system theoretically than what we have today.
Yeah, the thing that got me to make the leap to Bitcoin was that I was really thinking about the precious metals and sound money. And I just kind of said to myself one day, I was like, you know what? I don't really want to spend my gold and silver to buy anything like, as far as daily consumer products, but I don't mind spending something that's just basically its inherent value is zero, but it has a value because other people will use it as a medium of exchange. So so we can use it for basically currency. In the future, do you think any of these digital currencies will try to peg themselves to a commodity?
Oh yeah, I think it's completely possible that you could have a hybrid digital currency that's based on gold in some way. And again, I wouldn't even pretend to understand how that would happen technically, but it seems theoretically very possible. But what you just said, Dan, about not wanting to spend gold but being happy to spend Bitcoin is really crucial to understanding these concepts, because Bitcoin is a competitor of the dollar, not of gold. It's complementary to gold, but it is a direct threat to the other fiat currencies in the world, because that's, we if we're smart, we spend our dollars but don't save them to any great extent. Yeah. And so that's exactly what you want to do with Bitcoin. So you want to have a balance that allows you to transact, but not your life savings. So yeah, I think it's completely possible that in a theoretically conceivable ideal world, that you've got hybrid currencies that are based on gold but trade like Bitcoin.
John, in your book, you guys did discuss solutions, and as far as an individual solution and how to prepare and possibly profit from the crisis. For international diversification, what are some of the easy things that people could do?
Well, probably the easiest international diversification is just to store some precious metals overseas. And it used to be that was a very common thing for rich people, at least, to do. You just contract with a Swiss bank to buy some bullion, put it in their vault, and then you were as well protected as anybody could be. But those days are gone. The big banks, especially the Swiss banks, have been penetrated by the other major governments of the world, especially the U.S. So they are no longer safe, and they seem to be playing games with their customers' gold. We've seen some more or less defaults in the last couple of years, where big banks just basically said, no, you can't have your gold back. We'll give you cash instead. Yeah. And so if you're going to store gold overseas, you want to contract with a company that just does that for a living. That they're not banks. They aren't in the business of lending things out. And so they're safer, at least in theory, than a big bank is. And Europe is no longer as attractive for something like that as Asia. Someplace like Singapore or Hong Kong are probably actually better because they're less vulnerable to political pressure from the U.S. Another thing you can look at is overseas real estate. That's a booming business now. You can buy a Costa Rican condo or something like that. Now, this implies that you have a few $100,000s to throw around. Yeah. And unfortunately, for people with less than that, well, there's good and bad in not having a lot of money to play with right now. And one is that if you don't have a lot, you can't lose a lot when the stock market crashes or bonds go bad or whatever. You just don't have that many dollars at risk when the dollar is depreciated away. And on the other hand, you can't benefit from the coming currency crisis because you can't place a big bet on something that's going to go way up. But you can still do things. You can still buy a global commodity fund or something like that doesn't have a big entrance requirement or anything, and you can buy gold and silver yourself. And that's not international diversification, but it still is diversification away from the fiat currency that is your environment.
John, does 2014 seem like it could be the year, or are we still looking at something that's got years to play out?
Well, as we talked about earlier, I thought 2005 was the year. So, my ability to predict what's going to happen in the short run is kind of suspect after that. But I think we're at the point now where any year could be the year because we just have such gigantic imbalances out there. So it's really, I think in Jim Rickard's book, he talks about how complex systems can chug along for a long time and seem fine, and then they just blow up. And one analogy that he uses is a snow-covered mountainside. And one snowflake will finally hit and cause an avalanche, but that snowflake wasn't in any way special, and there's no way to know when it's going to hit. When the conditions are right, something like that will happen. A catalyst will come along. And I think we've created the conditions now for a catalyst to come along, and it's just a matter of when the right thing happens, or I should say the wrong thing happens, because this is not a pleasant scenario unless you're diversified into gold and foreign real estate and stuff like that. But for most of the rest of us, this is going to be a really unpleasant time. And adding to the scariness is the fact that we can't know when it's going to happen, because it could be something really innocuous, a small bank going bust, or a government that we normally wouldn't even care about defaulting on its debt, or some equity market somewhere in the world crashing. Anything could happen at this point to cause the system to start to spin out of control. And so we just have to put ourselves in a position where we're ready for it when it happens, and then basically just kick back and enjoy the show.
Yeah, I think Doug Casey says you either got to leave or you're going to stay here for the entertainment value. As far as gold and silver, because you have mentioned them a few times, people who understand this and kind of get the whole scenario and the risks, maybe they bought gold 2 years ago or 3 years ago or last year, and they've seen the dollar appreciate dramatically against gold and silver. What are your thoughts on this huge move down we've seen for gold from roughly 1900 to the high 1100 range?
Well, gold had a huge run. It went up for 12 straight years. And no bull market is a straight line. You have anything go up for 12 straight years, and it's ready for a nice correction. And this was a little bit of an outlier for the corrections that we've had during this bull market, but not way out. I think the 2008 was about a 30% drop. This was about a 38% drop at the very bottom. So it's consistent with the kind of things you see in a bull market. So we shouldn't be surprised that this kind of thing happens. And the strategy that I think the most reasonable advisors have been counseling people to follow up until now has been dollar cost averaging, where you buy a little bit at a time over time. You don't just jump in. So if somebody jumped in with all their life savings at $1,900 an ounce, they're hurting.
Yeah.
But if somebody has been buying $1,000 a week or $1,000 a month or whatever for the last 15 years, they're okay. They're still up, even though they're down from their peak. And they're buying more now than they could buy 2 years ago. So in that sense, they're actually doing a little better, because they're able to get this thing they want to buy more cheaply. It's on sale. And if it goes back up to 2,000, 3,000, 4,000, which I think it will over time, just based on the amount of paper money that's in the world, and we're really talking paper money becoming less valuable rather than gold becoming more valuable. Mm-hmm. But if it does that, let's say gold goes to $3,000 an ounce, then we'll look back on this as just a little squiggle, something that really didn't much matter. And I know that's hard to imagine when you're in the middle of a bear market, when the correction is reaching its most extreme. But that is the way it is in retrospect in long-term bull markets. You look back on the corrections and go, oh well, glad I hung in. And I think this will be one of those cases.
Yeah, and that scenario though, where somebody put all their wealth or something in gold at 1900, it's definitely, I'm sure it happened to a lot of people, because I don't know about you, but when I first kind of said, you know what, this is definitely going to happen, I think it was like around 06 or 07, and I literally put nearly 100% of my wealth into silver and gold, because you look at this scenario. People who are going to read your book, I think it's the prudent thing to do. You get educated, you go out and you buy some precious metals. You said kind of just at the end, once you prepare, you kind of just sit around and enjoy life. What are some practical steps you can recommend for people who are they pick up your book, they're just reading this? What's like the first thing they should be doing after they read your book?
Well, the first thing you want to do financially is start to look at ways to diminish your dependence on dollars. Because if you have, say, a bond fund, your financial advisor probably told you that was a safe investment. But bonds are basically just contracts which pay you a certain number of dollars each year and then give you back your original dollars at the end of the term. And if the dollar is being aggressively depreciated by the government, then that means the value of the income stream you get from those bonds is going down. So you don't want stuff like that anymore. Yeah. And you don't want bank savings accounts for a variety of reasons. Not just because the dollars in your bank savings account are going to go down in value, but because banks are getting into trouble now, and the new plan is for them to take money out of their depositors' accounts to bail themselves out when the time comes. So it's not even really your money anymore if you've got it in a financial account with a big U.S. brokerage house or bank. So you want to look at the risks inherent in owning fiat currency in a growing credit crisis and banking crisis. And you want to try and skew your asset base away from stuff like that. So buy some physical precious metals, maybe some really well-chosen real estate, like a rental house or something like that is a lot more stable investment than a brokerage account right now. And although you can still buy the stocks of commodity companies and probably do very well, oil stocks, gold stocks, things like that. But you're taking on an extra risk besides the risk inherent in buying a share in a company, and that is that your brokerage account might be looted by the government going forward. Mm-hmm. So the first thing to do is be aware of all the risks that are out there. These are new risks, things we haven't had to deal with in our lifetime. Yeah. And so a new set of risks require a new set of financial strategies. And in this book, we lay out some. There are more, but we give you the basics. And from there, you start branching out into more exotic stuff as you get more and more familiar with what's going on. But I think the most basic thing is to move your finances as far as possible out of financial assets and into real assets.
John, thank you so much. The book is The Money Bubble, What to Do Before It Pops. Where's the best place for people to go? Do you guys have a special website for the book, or should they just go to Amazon?
Well, Amazon is a good place to start, and it's available on the other online bookstores. And we've got the Kindle version out right now, the ebook version, and the paperback should be out by Monday. So if you'd like to, if your listeners would like to be put on the list for the blast email that's going to announce its release, they can email me at john@dollarcollapse.com. I'll put them on the list and let them know when it's ready. And in the meantime, the Kindle version is ready right now.
All right, John. Well, thank you so much for your time. Again, you guys wrote an amazing piece for people. The prudent thing to do, I recommend everybody read this book. You got to learn about the history of what's going on and how it's relevant to what's going on right now, which we actually are in pretty, would you say these are unprecedented times?
Completely. Countries have destroyed their currencies many times in the past. But this is the first time it's been global, because normally it's one country in the context of a sound money world. Yeah. And this time, all the big countries have fiat currencies that they're actively trying to destroy. So and we've never seen this kind of debt. We've never seen this kind of global fiat currency printing press at work. So this really is uncharted territory. And because of that, it's going to be bigger and crazier than anything the financial world has ever seen.
All right, John. Well, thank you so much again for your time. You have a great weekend.
Great, Dan. Thanks. You too.